And I first of all want to get your perspective on the key points of this budget. Clearly, details are still sketchy at this time, but I think a lot of people are happy about the changes we're seeing with respect to capital spending.
Hi, Wole. Yes, we don't have too many details at the moment, but the official comments suggest that there's going to be a massive increase in capital expenditure to about $2 billion in 2013. That's from $1.2 billion in 2012 and about $500 million in 2011. So clearly, it's moving in the right direction. And I think, it's in line with the president's ambition to transform Ivory Coast into an emerging market by 2020. For about 15 years, there's been very little investment in infrastructure and health and education and so on. So that's starting to change. But having said that, public spending at $2 billion would still be about 7% of GDP. So it's not that impressive, although we're moving in the right direction. I think what's also interesting is that there is this idea that the increase in the fiscal deficit in 2011 and 2012 should not continue. I think it's short-lived because obviously Ivory Coast faced a serious political context over that period. But the government wants to reduce the deficit to about plus minus 3.5% of GDP in 2013 and then revert to a deficit of minus 2% going forward, which would be in line with the historical fiscal shortfall in the country. And also what's interesting actually is that in terms of execution and implementation, the government has actually done quite well. I mean, if you look at the figures for the first half of the year, capital expenditure spending was only down, I think, 5% versus the target, which is much higher than the level of execution in other African countries. And in terms of recurrent expenditure, they underperformed by, I think, 3.3%, while in most countries, actually, the government tends to overspend on the recurrent side.
Well, clearly, everyone seems to be liking the story in Cote d'Ivoire. We have the likes of the IMF revising their forecast for the country's growth in 2013, or rather 2012, from 8.1% to 8.6%. So very positive news we're seeing there. And even in the budget, I think there's a lot of talk about a lot more tax coming in as a result of the improvement in business activity. Clearly, Cote d'Ivoire seems to be on the right track. And for me, I think there isn't enough discussion around the positive moves we're seeing in the country.
Well, yes, I mean, in terms of economic growth, I think, what explains the upward revision is obviously the low base effects in growth, because there was a contraction in 2011. But you also have a general improvement in confidence, in business activity this year, and higher public investment. I mean, having said that, the issue is that now the country is going to develop faster, so it will import more, and that will probably put significant pressure on the current account. So although Ivory Coast had a current account surplus in recent years, that's likely to turn negative going forward. And actually the IMF projects a deficit of about 5% of GDP or so in coming years. I don't think it's an issue in itself, because as long as you have high FDI, it's actually likely that you'll be able to finance this deficit. But overall, I think, yes, the momentum is positive going forward.
All right. Of course, some other positive news around Cote d'Ivoire is the highly indebted poor countries deal that they've actually sorted out to address the backlog of debt that they have. But moving forward, there's a view that they would certainly have to borrow a lot more to finance infrastructure, finance the whole reform process in that country. One thing that is very positive for them is the performance of the Eurobond. And I want us to talk a bit about that. What I'm hearing is that it's up 73% this year, making it one of the top performers, if not the top performing Eurobond in the world.
Yes, it is. Actually, it's up, I think, 73% year to date. The price is now around 87 and a half. And last year, during the short-lived civil war, it fell to 36. So I think, the market has been very optimistic here, and rightly so, because everybody expected that Ivory Coast would resume its regular coupon payments, which they did in June, and also because the market anticipates that in coming weeks there's going to be a proposal to repay the 3 missed coupons in 2011. So the country is basically normalizing its relationship with the international financial community. At the same time, after the EP completion point, we are in a situation where external debt is probably slightly above 20% of GDP from 50 to 60% a few years ago. And there is actually a lot of financing coming from other sources. Ivory Coast is in the process of securing a credit facility from China. The figures that we hear are to the tune of $4 to $6 billion. But I think what's more interesting is that the authorities want to secure a credit rating by 2014. We think they will start probably with a B+, and get back to global capital markets by 2014-15. So probably issue actually another Eurobond by then. And you know, if you look at the global liquidity right now, we're pretty sure that it's going to be oversubscribed. And in fact, Ivory Coast is still trading above other African countries in terms of Eurobond spread. And you know, if you assume that it's a credit which probably is slightly better than Ghana in terms of macro fundamentals, there's no reason why the price of the current Eurobond could not go up further. I mean, we think that actually this Eurobond could trade at 95 or so in coming weeks or months. So it's probably one of the few African Eurobonds where you still have some upside, in line with probably Egypt and maybe Angola to some extent. But everything else is trading so tight that it's just, you know, impossible to foresee any yield compression from current levels.